Howdy, Jacob here. Today we're looking at AZZ in the electrical equipment industry, 2.5 billion market cap on 3.5 billion enterprise value. Looks like they provide hot dip galvanizing and coil coating solutions in North America, first incorporated in 1956. All right, so surprisingly pretty impressive growth here. We're looking at maybe 6 to 8% compound annual growth rate for the last 10 years with mid to upper single digit return on invested capital. We are seeing an increase in operating margin and a slight decrease in gross margin, but both are fairly consistent, and an operating margin of 13 or 14% is pretty impressive as well. Balance sheet shows $4 million cash on hand with $953 million long-term debt. So they're quite leveraged here. It does appear that there was an acquisition in 2023. So let's see that they went into debt for. So 2023, a 1.2 roughly $1 billion net acquisition, and they went entirely into debt for it. Their dividend currently pays out 31 million in aggregate and 68 cents a share. Okay, I'm not sure how I did capture that. Okay, so I just incorporated that. So 68 cents a share, 85. So you're looking at less than 1% yield. So not a terrible yield, and one that they can afford pretty easily. I'd say 5-year average basis, maybe 70 million, and so that is about 40% of their 5-year average free cash flow. Their debt, though, on 70 million 5-year average is quite high, well over 10 times. And even if it is closer to that 150 figure, you're still looking at well over 5 times their free cash flow figure. And so they do produce decent cash flow, and looks like from the acquisition, their capital expenditures grew quite a bit. But they're definitely going to have to dwindle down this debt pretty heavily. And so I wouldn't be surprised if their free cash flow allocation was pretty much just paying the dividend, and then with the remaining 60% or so reducing debt. And so I think you're definitely going to have to incorporate that into your own assumptions. So for me, on the growth side, on revenue, I feel pretty comfortable with a 5% revenue growth. Let's do roughly in line with market average there. And then for margins, let's do a little bit of a range. Share change. Stock-based compensation is 10 million. Maybe let's do increase 0.5% there. And the dividend, keep that the same because they haven't increased that. So maybe I'll bump this up 6%. So what I did there is the dividend at the end of the 7-year period is probably going to be down in the 20 to 25% or 20 to 30% payout ratio. And then I'm giving them about 20% to reinvest, make acquisitions, and then 50% to their debt reduction. And I think that gets me pretty comfortable with these assumptions right here. But this is saying that the company's stock price needs to fall 59% to get the return we're looking for here. Again, you just have to put in your own analysis and balance out what you want the company to do with what they've done historically. And given that their debt is as high as it is in relation to cash flow, you'd have to understand that a lot of that capital allocation that would be going towards other things that could be better advancing the company might have to go towards deleveraging the company and just being a safer on balance sheet. So I do hope you enjoy the video. Have a great day. Thank you.